This is In Focus, the Hindu's current affairs podcast.
The Supreme Court is set to take up a plea challenging the constitutional validity of the Securities Transaction Tax, or the STT. This is a direct tax levied on all transactions that happen through a stock exchange. Now, this tax was brought in under the Finance Act 2004. It has since become a significant source of revenue for the government, netting an estimated 55,000 crores in financial year 2024-2025. But this petition argues that the STT is deeply flawed and violates constitutional guarantees of equality, freedom of trade, and proportionality. How valid are these arguments? Should it be struck down or retained with modifications? Welcome to InFocus. This is G. Sampath. Joining us today is Deepak Joshi, advocate on record at the Supreme Court, who is also a qualified chartered accountant. Deepak, welcome to InFocus. Thank you so much for joining us. So I want to start by asking you to give us a quick overview of how this Securities Transaction Tax came into being. Like, what was the rationale behind it? How does it actually work? And to take a general kind of an interest in this, does it affect stockbrokers more, or does it affect even somebody who's investing in only through SIPs? Do they also end up paying it? Just give us a quick overview of this. Yeah,
we'll have to travel back 2 decades. Till 2004, there was no STT in vogue, and STT was for the first time introduced by Honorable then Finance Minister, Mr. P. Chidambaram, in his 2004 budget. STT was introduced alongside the abolition of long-term capital gains on listed equities. In fact, he's gone on record in his speech then in the parliament that I am abolishing the long-term capital gains on listed equity shares. Instead, I am introducing this STT, which is a minuscule percentage, on the transactions done on such securities.
Minuscule as in like 0.
Yes, it's 0.12% for some instruments, it's 0.2% for certain transactions. There are 4 or 5 slabs, but everything is below or equal to 0.2 or 0.
So this long-term capital gains, it's still not there for equities.
That's where the change has come recently. I'll come to that later on. So the idea projected was that you will no longer be levied a long-term capital gain tax, but for the government purpose, for many reasons, STT will be a tracking kind of tax. It'll track the transactions. It'll track if someone has sold securities or bought securities. It is also a revenue generation instrument for them. And it is very simple to implement. You just pick up a transaction, apply a flat rate, and be done with it. This was the objective in 2004. Now, to directly answer your query, 2018 is when LTCG, this long-term capital gain tax, made a comeback. However, STT was not abolished. So if STT was a substitute, a milder substitute for LTCG, then when LTCG came into vogue again, perhaps some tinkering ought to have been done for STT, but that wasn't done because it was a huge revenue generator for the government of the day.
So when this long-term capital gains made a comeback in 2018, at that time, nobody went to the Supreme Court saying abolish STT. Did anybody do that? Why come to the court after 20 years?
So noises were made in the policy sphere, but no legal action or remedy was taken. And you also have to understand that these things move in cycles. Now, the stock market, the allure of securities and entering into transactions of intraday transactions, becoming a trader is very attractive. And the number of volumes have also increased. Perhaps now people are starting to realize the cost of this on their business and on their trade. And perhaps one gentleman has now approached the court.
Right. So does this affect those who are doing this intraday trades more? Or does it also affect like retail investors who basically approach the equity segment through SIPs and so on? Are they also, is it really, when I say affect, does it make a dent in their whatever returns from the market to that extent?
Okay. So primarily everyone is charged in STT when they are dealing with listed securities, whether for intraday, futures and options, derivatives, or for a delivery-based long-term investment. Even for mutual fund investments, STT is levied, but at the time of redemption, when they are selling off the mutual fund units. But to answer your question whether it makes an equal kind of dent on everyone, the answer is no. Because for a trader, an intraday trader, who's doing thousands of trades in a day worth hundreds of crores, this minuscule charge ends up being a figure in crores for him. And please bear in mind that the government and the stock exchanges have come out with figures that if you exclude the private brokerage charges, STT is akin to around 55% of the total cost of a trader, excluding brokerage.
55% of the total cost of a trader.
Yes, every charge that he bears. You have stamp duty charges, you have DP charges, SEBI listed charges. This one bears 55% of the total proportion, excluding brokerage.
Total proportion of all the charges he has to pay.
Yes. Okay. So it's a huge amount if you see in proportion, and that is where the dent is. For a normal long-term investor who invests just once in every 2 years, 5 years and waits for the capital appreciation, it doesn't hinder much.
Fine. So it's a concern which is more important for those who are doing this on a daily basis as a profession. Okay. So this petition, it talks about something called event-based taxation. I'm not a tax person. You probably have an idea. So is this a particular kind of taxation that is done as opposed to tax on income, so to speak? Like, what is this event-based taxation? And this STT is supposed to be a particular kind of this event-based taxation.
Every taxation levy has to have a subject matter on which it is being levied. What we call an event-based taxation is, in normal words, a subject matter. What is the subject matter which kicks off the taxation? It can be a generation of income, a personal income, a business income, or an income from trading in shares. This is where the income tax is levied. It can also be a simple act of transaction between two people. For example, this is a transaction between a buyer and a seller of shares. And this is where the levy of Securities Transaction Tax gets kicked in. A parallel example is GST. It's a transaction of supply of goods and services between two willing buyers and sellers. So again, it's an event-based tax. You can say it's an event-based tax, but it's related to the subject matter. You have to identify the subject matter. So today, when you are talking about STT, the subject matter is the transaction of securities, of certain securities. Whereas when you talk about income tax, capital gains tax, it's a post-fact levy where the transaction has already happened. Now the subject matter is the generation of income or loss on which tax will be paid or refunded or adjusted. So that's the primary difference between the understanding of a transaction tax, so to speak, and an income tax or a capital gains tax.
I mean, even if you're taxing an event or a transaction as a subject matter, as you said, doesn't there have to be some kind of a more narrower definition of what can be taxed? Can any transaction be taxed? Isn't there some kind of a certain kind of economic activity which results in, say, a profit or something like that? Isn't there a narrower definition, or you just say anything which is an event I will tax? Is that how taxation?
No, there is no free hand to the government to say that anything and everything under the sun will be taxed. It's also the Supreme Court has laid down various tests, specifically in taxation jurisprudence, that there has to be a set criteria, a well-defined criteria, a rational nexus with the objective that is being sought to be achieved. It can't be that any and every transaction the government says passes a law that this will be taxed henceforth. The government has to come up with reasons. For example, at the very beginning I explained one of the reasons was revenue generation. Now that can be a valid reason.
One other reason seems to be to curb tax evasion.
Absolutely. I was coming to that. Curb tax evasion and also curb speculation in the financial market. Introduce a lot of stability in the financial markets. Because if the dent is more on speculation, that activity ought to reduce.
How do you evade tax? How will putting an STT lead to less tax evasion or eliminate tax evasion?
Okay. So just for a very simple example, I'll give you two examples. One is a very simple example. There is a person who has who has never filed an income tax return. He manages his affairs in such a manner that the taxable limit doesn't get crossed. He may have different PAN numbers, which is itself illegal, but the government has no option or ways of tracking that person. And he files income tax returns with 5 PANs, each below the exemption limit, and deals only in shares and securities, gains, losses, whatever is there. The government has no wherewithal to track that person or tax him eventually. STT enters the picture. Irrespective of whether you are making a gain or loss, the reporting goes to the government, because against your PAN, against your name, now there is an entry that Mr. So-and-so has bought 100 shares and has paid an STT of this much. So the government will now have a linkage in your file and can track your monetary transactions in that manner. So that's one way. The other, of course, is back in the time when this was introduced, there was a huge abuse of double taxation avoidance treaties. You might have heard of the Mauritius route, the Singapore route, and tax haven routes. Those foreign investors used to invest in India and take out money after selling the shares. There was no capital gain tax on them. So government was losing out on the tax revenues. But this STT, because it is a transaction tax, it was levied on them also at the time of purchasing and selling, both sides of the transaction.
Right. So that is one of the main challenges of this petition, which says that a key argument of taxation is that you should not tax the same event twice. So here, this stock trader, Mr. Juneja, he says that the STT does double taxation. You're taxing the seller, you're taxing the buyer also. So that way, it's arbitrary, and I think there is some constitutional provision which it sort of violates by virtue of being arbitrary. So is that a valid kind of an argument?
The petitioner therein has invoked Article 14, that arbitrary challenge. Simply broken down, it means that it's irrational, it may be disproportionate, and has no rational nexus, because the double taxation has no basis in law or logic. So it's arbitrary in that sense, Article 14. The gentleman has also invoked Article 19, his right to profession, wherein I understand from news reports that the argument is that because of the disproportionate impact on the profits, because of this levy of STT, and also because of non-adjustment of STT from the subsequent profits, his right to profession is getting hindered. There are two ways of understanding this. One is, of course, I'm now giving you the answer which a government would justify. They would say that when you talk about STT, the subject matter is quite different from what you talk about capital gains or income under the Income Tax Act. The subject matter of STT is a simple transaction. We wanted to capture the transaction, therein lies the rational nexus.
So you can, if you wanted, the objective is to track a transaction, you can track it. Why do you also have to tax it? There are ways of tracking without taxation, right?
Absolutely. And this is where this is the strongest footing of the challenge. Either the government says this is not a taxing mechanism, this is only a tracking mechanism, which you will also find similar to certain TDS or TCS provisions. They're not taxes. They're collection and tracking mechanisms. And you get a refund or an adjustment on count of TCS or TDS against your final income. But the moment the government says that this is a tax, then ordinarily, logically, you have to provide an adjustment, a seamless adjustment in the same line of transaction. If that line of transaction from buying to selling ends in a profit, whatever has been incurred as cost, which cannot be escaped, ought to be adjusted against that profit, because that profit is getting taxed. This STT is also a tax.
But this logic doesn't apply to GST, for instance, right?
It does. It does. In fact, when you are buying something, you pay a GST on your inputs. And you claim whatever you've paid as GST on your inputs as input tax credit. The very name credit shows that it will be adjusted against a future output liability. You will be given a credit of that. You've taken that input, you've manufactured something new out of that input, and you're selling it in the market. You're charging GST from the customer and paying it to the government. The law says that whatever input you've incurred, input tax credit you've gained, that will be available to you to adjust against your output liability. So you only pay net GST.
So there is reconciliation with.
Absolutely.
This applies also to the end buyer, the customer as
Absolutely.
well.
Absolutely.
So you said earlier in the conversation that this tax is like the GST, but unlike the GST, there is no scope for reconciliation. So is this the only tax among all the taxes we have in India, which is an event-based transaction tax, which doesn't allow for any kind of reconciliation at the end of the financial year, or are there other such taxes?
There are other such taxes, and they've been there since decades.
Such as?
Entry tax. Every state levies an entry tax, irrespective of whether the produce which is being imported into a concerned state ends up in a profit, loss, or no sale. There is an entry tax. Every state has its own entry tax.
So you can't set off this as a cost?
No, you can't. In fact, there are certain turnover taxes and purchase taxes also, which are levied by concerned state governments.
You spoke earlier about this dynamic between the STT and the short-term, long-term capital gains tax. So would one way of addressing this concern be to sort of do away with the long-term capital gains tax, which wasn't there when the STT came in? Would that solve the current question?
That would very well solve the current problem. But the government has already revived long-term capital gains tax in 2018. And going forward, there appears to be no signal that they are going to abolish LTCG. They may simplify it, but they are not going to abolish LTCG. Even under the new Income Tax Act, LTCG is present. So the next best alternative is to give a credit of whatever STT you have incurred against the LTCG, because the both of them are intrinsically connected to the transaction of shares or securities. If the base is common to both of them, it is only logical that you give a credit, input credit of the STT against whatever has been sold, and you are being charged a tax on that.
But this wouldn't help those who are only dealing with short-term trades, right? Who don't fall under the long-term.
No, if the proposal is to adjust, it will be adjusted against STCG also and LTCG also.
And what is this Article 21, which has been flagged as being violated by the STT? How does it affect Article 21?
Article 21 is the right to life, live with dignity. It's not a very detailed article under the Constitution, but the Supreme Court, through various judgments, have interpreted various facets of life, of an individual, of a company, etc. One of the facets is right to livelihood. Now, this right to livelihood is actually connected to Article 19 also, right to profession. So both of them go hand in hand. And once the gentleman says that if I am incurring a loss, even then I am made to bear the burden of STT. Then it eats into my capital. I've already lost my capital. Whatever else is remaining is eaten into that because of the levy of STT. And because of this, it is unconstitutional. Only on this basis, it may not be a strong ground. There is right to livelihood, there is right to profession, but there is no right to protection of capital and right to profitability out of a business. The Supreme Court or any other court could come back and say that whatever you gain or lose is because of your business acumen and your talent. It is not up to the government to ensure that because you've lost certain money, they will have to reimburse whatever has been charged by the government on the transaction.
So this Article 21, I mean, even as a layperson, I thought it was a bit far-fetched, right? Okay, so of these three constitutional provisions which have been invoked to say or argue that this is not constitutionally valid, which one do you think has got the most...
It's got to be Article 14, the arbitrariness. They can add more teeth to the challenge under the head of Article 14 itself by arguing that this is also disproportionate for those who are actually trading day in, day out. As I've told you, it accounts for 55% of the total cost for them. excluding brokerage.
Can the government respond by just reducing the percentage and make so that it's proportionate instead of just,
They may, but it's not the job of the court to do. The government in response could, but the court will never legislate on behalf of the government or through their judgments.
No, but the court will have to say whether the government's response is okay with it, whether it's okay with it or not, right? I mean, if the petitioner has to say this is not enough, then the court will have to say no, yes, it's fine or not, right?
So the experience has shown that courts generally allow a greater latitude to the government in matters of economics and tax. They say that the government knows the intricate details of the transaction, and there are experts suggesting and giving way forward to the government. It's not for the courts to now challenge or view a policy decision with a view that maybe this is right, maybe this is wrong, we could have done this, we should do that, because the court is not full of experts. They are only looking at the legality in the four cornerstones of the Constitution. That's about it.
So my last question to you on this, do other countries also have something like our STT?
They do. Some of them have abolished, but some of them still continue to have STT, different names. For example, Taiwan, Euro, and UK also had one, Financial Transaction Tax. You have certain Southeast Asian countries also who continue to have this FTT. Of course, it may not be as high effectively as our country, and not every kind of transaction will be covered therein. But it's wrong to say that no other country has this.
Yeah, but the US and the UK, where the countries we seem to keep looking at for comparison, they don't have it, I suppose.
But they have had it in the past.
This particular topic, I think, has got a lot of traction also because this is coming at a time. The context is that there is a sense of frustration about, there's a lot of taxation happening and people don't seem to get the sense that they're getting much in return from the state. You're paying GST, you're paying income tax, you're paying this tax, that tax, toll tax, but there's not much happening. And then there is this STT as well. So in this context, I think the Supreme Court is going to hear it maybe after like 4 weeks.
Yes.
So
How we should notice to the government.
Yeah. So how do you think this is going to pan out? Do you think the government will be put on the defensive, given the broader context of this growing resentment, especially of the middle classes, against all these taxes, or that's not going to be a factor?
There are two ways to look at it. Number one are the figures. The provisional collection figure in the budget documents for the current year on account of STT have been 53,000 crores. It's a huge amount. Previous year, the collection was around 34,000 crores. So as you rightly put, the collection is huge. What is the person getting in return, or where are these taxes being utilized? That's something which the government will be on a back foot. But the other way to look at it is, historically, taxing a financial activity has always been easy for a government rather than taxing a more comparatively productive activity. The government will not face much backlash when it taxes something as something similar to a stock exchange or a security transaction, as it may get a backlash on increasing income tax rates on a salaried person. In fact, when LTCG was reintroduced, everyone was sort of feeling unhappy about it, but the government kept at it. They said that this is a non-productive activity. You are just speculating and gaining at the expense of speculation. To that extent, the government will go aggressive on this. Because they may say that whatever is the speculation being introduced in the system, our aim is to curb that speculation, and this is a valid aim. And this is a proportionate aim for which this levy has been enacted. So it's a balanced view. The petitioner is right in his thinking. The government has a valid ground to defend the levy.
Right. I think when you put it like that, even those who are under the idea that this is something really arbitrary, I think they will take a pause and think about it. Okay, it's only a financial transaction. At least they are not taxing productive activity, and
because the government has taken that defense historically every time such levies have been challenged.
Right. I think Mr. Juneja will have to think about that too. Thank you so much, Deepak. As always, pleasure talking.
Thank you so much for having me.
This episode was edited and produced by Jude Francis Weston. If you liked it, do subscribe to In Focus by The Hindu on Spotify, Apple Podcasts, or wherever you get your podcasts from. Thank you for listening.